Good day, fellow investors. Stock analysis time. Walgreens and Warner Bros. Discovery keep crashing, and as we discussed these stocks already over the last years, it is nice to give an update as we are at multi-year, multi-decade lows for Walgreens that has reached the price of just $12, and perhaps now we have to start thinking about market capitalization. $13 billion for the whole business, and since the peak in 2015 we are an incredible 87% down for such a strong brand, such a strong business. Similarly, Warner Bros. Discovery down 70% since the spin 2 years ago, and it seems like there is no end to these stocks going down. The market capitalization $18 billion, and we have discussed this. Warner Bros. Discovery looks good, not good enough for me. That was just a while ago. We are now 14% lower, and Walgreens Boot Alliance now at 13.12 is really interesting. So let's dig into first Warner Bros. As they had their earnings result in May for the first quarter, and there are some interesting developments, or better to say confirmation of the initial investment thesis. Free cash flow is there, so they are making money. Revenues are there, some decreased, but some is improving. That's normal within the industry. They repaid 1.1 billion of debt during Q1, so they have the cash to keep on repaying the huge and perhaps the key issue there, which is the 43 billion of gross debt. However, if you look at this, remember the market capitalization of what was it, 18 billion. There were almost 100 million subscribers DTC with an average revenue per user of 7.83. Now that is something, because if I compare this with Netflix, they do have 270 million paid subscribers. However, their market capitalization is at 260 billion, so a billion per million subscribers. If we turn back to this, so the market cap could be 100 billion if we compare this to Netflix. We'll discuss in a second what has to happen to compare this to Netflix. And they keep doing what they are doing. Godzilla, King Kong, whatever. 1.2 billion global box office. Dune Part 2, the highest grossing movie of 2024 to date with 700 million. And of course, when it comes to the stock, the debt is the focus, but they keep having cash flows, and they say their focus is now to stabilize everything and keep repaying the debt. We have calculated that the debt will be repaid for the next few years. So the key question is, what will push the stock up? Because if they're spending all the money on debt repayments, the market doesn't see that as catalysts. And when it comes to investing, there is one rule. I have never seen a stock being flat. A stock either goes up or down. And in this case, there is negative sentiment. People are still selling this company because I think very few want to wait for 2027, 2028, when they will stop repaying the debt and they will start doing buybacks or paying dividends that could revalue the company. Because if they make 4 or 5 billion of free cash flow, 4 or 5 billion per year, times normal P ratio of 15, that's a 60 billion market capitalization, which is then a 3x, not to mention the 100 million subscribers. Compare that to Netflix. As I said, even there, with the more subscribers and everything, a stock either goes down or it goes up. There is no flat when it comes to investing, because there is so much about momentum, so much about trading, and just small improvements change the trajectory of a stock. Netflix has had its time of pessimism. We'll see now when Warner Bros. Stops with that pessimism to see increased prices. If you look at the company, the question now will be, David, what will you do to turn this stock price around? You are doing everything that you have said, the cash flows, repaying debt, but we have to ask ourselves, what's the value and how can that value be unlocked over time? Because as an investor, you want to see or dividends or buybacks to push your stock higher. If that is not happening, then why invest? People capitulate, and therefore the only trajectory for the stock is going lower. If I look at the value there is approximately 3 billion of cash. There is the goodwill from the merger with Discovery and everything, intangibles of 60 billion, the value of the movies, of this or that, of the televisions, of the brands, of everything. And then you have a big chunk of assets there of 120 billion. This leads us to an equity of 45 billion compared to the market capitalization of 17. Now, the question is this equity realistically showing the value or not? That can only be answered with the cash flows, and I think they are doing 3, 6, 7.4 billion in free cash flows, a billion more, a billion less. Thus, there is real value, and I think that for a private owner, this company could be worth more than 70 billion because of all the brands as we discussed. So probably you are using something of that, and compare that also to Netflix, where there is exuberance. This stock is going higher, but the key question is again, what will push the stock higher? What will David do? We'll update on earnings in a month, because reading through those conference calls might give you some clues, might give us some clues about what will happen and what's going on. It's definitely cheap, and we will talk more about that in the strategic conclusion at the end of the video. Walgreens, a clear disaster there, 87% down, recently crashed on earnings to reach 20-year lows of $12 per share. What's going on? There have been these earnings, and they have lowered earnings per share from $3 something to lower that, which put the market in selling mode. They say they continue to face a difficult operating environment, consumer weakness, pharma issues, but maybe there is something else that we'll discuss in a second. So a lot of things going on, but they are still profitable as a whole, as a business. So adjusted earnings per share are still there, as they expect, around a little bit less than $3, $3.80. I looked at the debt, 8 billion. There is a lot of leases. Most of their stores are leased, but again, that's the business. It is deteriorating, but still profitable. And the question is, how much value is there left, or is the business model completely broken? If you look at analysts, everyone is cutting their price targets as the stock has crashed, narrow margins, bad pharmacy space. This is from Bank of America. They don't know whether the transition, the turnaround, will do something positive or not, because the pressure on the company's gross margins and earnings power is driven by structural headwinds to pharmacy reimbursement, and continued weakness in the general merchandise sale will remain. So they see the company as doomed, and therefore the stock price is crashing. What has to happen? Well, as we discussed earlier, they need to just beat the expectations that are now priced into this stock price, and then the stock price will go up again. Of course, it can go first down, then up, but I would expect a lot of volatility. To dig a little bit deeper to discuss the earnings call, a little bit about what does the CEO say. And he says that the current pharmacy model, which is the business itself, is not sustainable, and the challenges in our operating environment require we approach the market differently. So when the CEO of a company says that the business model is not sustainable, then you know the company is in trouble. Okay, they are still profitable in a way. There will be a lot of impairments, especially now with them looking to close 25% of stores, so Rite Aid acquisition, whatever, but they are going forward with and that's always uncertain and unliked by the market. But one thing is uncertainty, one thing is pure risk. We have to keep in mind that the business sales keep on growing. 2%, 2.3%, healthcare 7.6% growth, earnings per share are still there. I think they are still paying a dividend. Maybe they will cut it in the future, but they are still profitable, and now they are doing that strategic review and they will close 25% of the stores. They continue with Boots, they are not spinning it off for now. They continue with Village MD, etc., etc. So the business is still there, but let's look at the Q&A session, because then you know immediately what worries the analysts, that then is reflected in the stock price. Lisa is asking about the future of pharmacy as a whole in that retail brick and mortar model, and the answer there is they're focused on the value they provide, but no direct answer that there will be a future. As the CEO already said, it is a structural problem. And then question on the leases, the high amount of leases, how will that reflect? And here is something that I caught from the conference call. And they say it will not be meaningful because those are great positions and locations, the best corners in America, as the CEO said. Then I say, well, if those are the best corners in America, and you cannot break a profit on those stores, then there is something really structurally problematic with your business model. And maybe Tim Wentworth, the new CEO, is digging his own grave here by saying how complex the industry is. And maybe they will do their best to turn the ship around, but you never know. And then prescription not coming back to pre-pandemic level. And then a question from Anne here. How will the stock react? What can they do for the stock price to improve, return to previous highs? How are they going to stabilize operating profit in the retail segment, free cash flow? And will it happen by 2026, or when can they give us a time frame so that we can model things and maybe re-rate the stock so that the stock goes up? Great question, but they say they see a clear stabilization is going to take time. Of course, they cannot project it, but when it happens, if it happens at $3 a share, earnings per share, then the price will be around 2025. So that's 100% upside, and that is the uncertainty that the market is seeing. The market wants to know when, not if. But the question is also if, because also the CEO here says, I knew that retail pharmacy was largely overbuilt for where the future was going to be, particularly given the possibility of technology, home delivery, and so forth. Therefore, not giving any guidance, but just an analyst asking whether the earnings per share 2025 is in the low 2 range, which you can start thinking about what the analysts are pricing in. And I think this is a little bit of a market overreaction, because if earnings are 2.5, that's a P ratio of 5.6 next year. So if they just do 2 and stabilize things, that's 24 per share. That's 100% up. The key question is, can they negotiate pricing with the suppliers and improve margins? And that is the key question. Likely not, because if so, they could improve margins. And if they are not taking those medicines at those low margins, then customers are not coming in. And that is the structural problem and the broken model of the business. Is there any value? They say 75% of stores remain profitable, so there should be some value there. If they just have 1 billion of free cash flow stability going forward, close things down, sell some assets, just the UK, Boots Alliance, then you think some activist can take it, because we are talking 10 billion. Just 10 billion, which could be some appetite for a private fund or something. So I think this is capitulation from investors. They are 86% down, and therefore very interesting. I think there is value there, and if you start looking from a Ben Graham value perspective, beaten down, unlike stock, from a value to private owner over the next 5 years, I think with these market caps, you should, as an investor, keep in mind, these strategies imply you have 20 plus of such investments, and then some don't do well, some do 3x, and it is a good long-term strategy if you are looking for something like that. I prefer businesses that are already delivering. I will look into this to see whether there is some catalyst forming over the next year, 2 years, that the market might not recognize, but already now I think these things are cheap, and cheap can always get cheaper. Keep that in mind, but the question is how much cheaper, and then what is the upside? At these levels, it seems the market has capitulated. Both companies look cheap compared to what they offer, what's left, even with all the issues and the bad news. Thanks for watching. Subscribe if you like this, and check my research platform.